This is the Friday, March 27, 2020 version of the Market Plus segment. Joining us now, Dan Hueber. Hello, Dan. Through the power of technology, we go into your work area. I had a chance to talk with you earlier this week, and I'm going to stump you. I didn't tell you I was going to ask you this. You had a keyboard behind you. We know Naomi Bloom can sing. Do you play the keys, or what's the keyboard back there for?
It's all there for a prop. So occasionally I'll get over there and work it a little bit. I mean, I'm quite rusty. I haven't taken lessons really since I was a child, but do enjoy participating in music here and there. So yes.
And your office there overlooks the neighborhood, and you get to see maybe some rain come through that area. We're seeing a lot of people stuck, not able to get in the field, and maybe that's a good thing. We all need to be cooped up, I guess, together. But we'll start with the cotton market here. That market continues to it's kind of like corn, keeps taking an abuse. What is happening there?
Well, I see what you're trying to do here. You want to start with a market that is the absolute most depressed, so everything else will look a little bit better comparatively.
Right.
But I mean, granted, cotton, as in so many markets, but I mean, certainly in cotton, is just a victim of what's been happening on this global virus that has just, of course, swept the entire world. And, the industries that, of course, depend on cotton consumption and the clothing manufacturing and the retail industry are virtually on shutdown. So, I mean, I think, and we were already in a long-term slide lower well, I shouldn't say long-term. We'd come off some of the lows, but I mean, this just was the last nail in the coffin. Here it has, of course, driven down to levels not witnessed since the heat of or I should say the depths of the Great Recession back in 2008, 2009. I do think, the pressure on Monday really stuck in the low for the week. And then we primarily went sideways from there. So, maybe some of the first indications that enough is enough, that we've reached low enough. But boy, we're going to have to see some positive news or a little more positive action to say that with much confidence here next week.
Yeah, it gapped lower into new contract lows, 6th straight day lower on Monday, and then we kind of came out of that. Late today, commitment of traders came out. Was there a couple of commitment levels that kind of surprised you?
I guess the only surprise, and maybe it shouldn't be a surprise because the corn market really did not, we closed it fractionally better for the week, but I mean, really did not perform. But, as of course, this is through the 24th of the month, large managed money still sold almost 17,000 contracts of corn. They're short of around 108,000, which seasonally is probably heavy. By no means is that a record amount. My way of thinking, though, is, with so much risk in front of us, as far as growing season and planting questions and summer weather and this type of thing, that would tend to say, that's a lot of corn to cover as well, if they happen to get scared out of there. But, we're going to have to give them a reason to get scared out of there as well, too. They seem to have all the ammunition on their side. Market, yes, they were sellers of another 27, almost 2,800 contracts. Were solid buyers in Chicago wheat. Now they're long in that market by about 17, almost 18,000 contracts. We're buyers in all the wheat contracts, and then substantial buyers again in soybean meal, 23,000 contracts for the week, taking them to nearly 40,000 contracts long. So you can see where that firepower on the wheat has been coming from.
All right, I got to fly through a lot of these great questions that we got this week.
Sure.
We're going to start with Jonathan in Wisconsin, who hit us up on Twitter. He wants to know, Dan, is there any positive info for producers holding unproved old crop corn or soybeans?
Boy, I tell you what, it's hard to find any glimmers of hope here right now. And of course, it's like the old saying, we saw that light at the end of the tunnel, that it might be a freight train. So it's hard to say much good. Other than, and I will throw in a caveat here, particularly when it comes to the export side of it. I mean, we have seen a nice pickup definitely in the corn sales over the last 2 to 3 weeks. So if your market is a export channel, if you're moving down the river system into the Gulf or potentially out to the Pacific Northwest, we could start seeing some improvements there. Probably the best thing you can say is we're drastically oversold. We're due for a bounce. But in the corn market, to get that to carry very far, I think is going to be a real challenge, particularly with what we're facing in the demand from the ethanol side of the industry. Soybeans, maybe a little different situation, and again, beans have performed pretty well this week. We got up against a very tough resistance level. But if we could see some more additional Chinese business to come in there, or maybe see another resurgence in the meal market, that could be the one market. Yeah, and here again, too, I'm not looking for a runaway, but it's not unthinkable to see another 20 or 30 cents over and above what we posted this week.
Well, maybe we can get a little bit of gain on a stronger basis. Mike was asking, what do you expect basis levels on corn and soybeans to do in the coming months?
Yeah. Here again too, in this corn market, if you are, of course, the big criteria here is number one, do you have good quality corn? I think good quality corn is going to be able to look at some pretty good premiums this year, because there's just a lot of corn, particularly in the upper Midwest, that is not of the grade that people want for export or feed, either one, if they can avoid it. If your dominant market is an ethanol plant, that's going to be difficult. That's going to be tough to look for much improvement in basis. But if you are moving into the export scene, then yes, I think we have some room for some improvement there, because we do seem to see demand shifting back to that export side, and I think there's a little brighter picture there. Again, with beans as well, we know, like I say, this week we finally saw some pretty good numbers come in from China, and I don't think that's going to stop. I think China knows they need beans. They're having a little difficult time. Generally, they're going to get beans out of South America at this time, but not only has there been some weather issues that have slowed the bean shipments out of Brazil and Argentina both, but now you've got issues where they're having difficulty getting workers to move the product into the ports, move the product into their processors, so that could start shifting a little more demand back to the U.S. as well.
All right, and then we have this whole little thing called Acreage report coming on Tuesday, the prospective plantings. This one's a big one. So Shane in
Absolutely.
Bloomfield, Nebraska is asking via Facebook now, with the large price difference in wheat versus corn, how many acres will this potentially buy from corn? And then he's also asking probability of Dees 20 corn hitting 420 before July. Let's take the acreage shift. Is there anything moving in this report that would be surprising?
And again, it's all back to where do you start from? And of course, if we go back to a year ago where, but there's always been the debate on how many acres would have been planted last year. And if you really believe some of the data coming out from the USDA, gosh, we were going to plant 100 million acres of corn. So, where do we start from? The trade is looking for about 94 million acres planted this year. And I think it's a pretty reasonable assessment. I think some were maybe pushing towards 95 million at one point, but I do think just the topic you're talking about, that we could see a little bit more shift back over to spring wheat. That could pull some acreage away from corn, and we could see something a little bit heavier in the beans. And not that there is a major price advantage for beans over corn at this point in time, but if you're looking at some financial stress, we know it's a lot less expensive to put a crop of soybeans in. If you can cash flow them, I think you're going to see a few more people move into that direction. Now, countering that in the South, if we use cotton as an example, it would be hard for us to want to put cotton over soybeans at this point, so we could see some bean acreage pick up in the South now.
All right, so we've talked about a few other factors. There's another one that we need to discuss, and that is in relationship to the dollar. Another question that came in, this one is Aaron in Minnesota, came via Facebook, which is Market to Market Show. He's asking, with our economy slowing because of COVID-19, will that drag the value of our dollar down to a point where we can be competitive in exporting again? You already talked about the port issues in South America for both the COVID aspect of it, but what's the dollar aspect? We're back to where we were a week ago, which was bumping up to 100. Now we're back to 98.
Correct. Well, and great question. I think it's probably one of the most pertinent things that really could impact us in the year ahead. And I think absolutely. I think the last 2 to 3 weeks are an abnormality as far as I'm concerned. I mean, people globally just rushed into the dollar as a safe haven. They panicked with the investments they had. Of course, as witnessed by what the kind of breakdown we saw in the equity markets. You look at the T-note and the T-bond markets. I mean, they just screamed to record highs, and people just wanted a place of security. And not that we don't have our issues here, but I mean, we were still probably the most secure and most liquid place to invest money. And I think it overinflated it. And if, like I say, if we go back 3 weeks ago before all of this blew up, the dollar already looked like it was turning lower. And I think we'll resume that path here, once we kind of get past the hump of excitement here with the spread of this disease,
Right.
and and we start seeing trade just return a little bit more closer to normal again.
We did see some running towards the safe haven of gold, up 11% this week. All right, I have just a couple of quick more questions before we get out of here. Terry and Cindy in Roseville, Illinois, they had a question when it comes to the unexpected closures of ethanol plants. We kind of graced about that at the beginning of the show here. With the unexpected closure of ethanol plants, what are the prospects of livestock on feed due to feed efficiency?
Of course, I think there's an ample amount of other substitutes that are there. Of course, we're going to have to rebalance some rations and this type of thing. But I mean, that's maybe not as challenging as it once was. But certainly, I think people are going to look at, primarily corn. And again, that could be one of the bright spots in the corn market domestically and internationally moving forward, as, the rest of the world really looks at wheat as a foodstuff or a feedstuff as well as a foodstuff. And, right now that could start shifting some of that demand as wheat gets higher priced and in some countries even restricted. I mean, Russia came out today and said they were going to probably look at putting some quotas on some of their wheat exports as they move in through the year. So I think that could be a little bit of boost of the corn. But again, I think the avenue of having less DDGs around to feed, that just probably boosts up some of our demand and some of the other substitute products.
Last question. It's a hybrid a little bit here. We had a couple of questions. One, Jim in Denver was asking long-term. I want to ask you, let's look 6 months out here. Jim's asking, how do you see all these long-term impacts, third and fourth quarter, playing into prices? I want to take this question one more level. What's a bigger factor here moving forward 6 months, 12 months? Is it that pressure of COVID, or is it the traditional pressures of what we see in the grain markets, whether it be weather, demand, usage, issues like that?
Yeah, boy, you want to get it? I mean, challenging question. Absolutely, COVID is your classic black swan event. I mean, nobody really, I shouldn't say nobody, but I mean, it was very out of the blue. I mean, took everybody by surprise, not only in the extent and how it's impacted health, but how rapidly it's spread around the world. That said, if we can gauge by what we've seen happen in some of the countries where this originated, and really was, of course, so virulent to begin with, they've kind of moved beyond that point. They're trying to start their economy. So I'm going to say the 6 months from now, the bigger questions will be, one, have we been able to jumpstart our economy again? I mean, is the $2 trillion package that was passed this week going to be enough to kind of soften that blow, as did the TARP back in 2008? And that said, we have no grasp necessarily yet on what world weather is going to be, and I think that will ultimately be the big caveat here on what's going to determine how we perform in prices here moving later into this year.
Dan Hueber, it's good to see you. I hope next time when I see you, you're sitting about 6-7 feet to my right.
That would be great. I appreciate it. Would look forward to it.
All right. Thank you very much, Dan Hueber. We appreciate him joining us tonight. We are also glad that you joined us, and we hope that you join us again next week. We're going to assemble a panel. I got to admit, it's going to look a little different. Think the Brady Bunch. It'll be interesting, to say the least. We'll have the 4 analysts break down the numbers in next week's USDA reports. So until then, thank you so very much for watching, listening, or reading. I'm Paul Yeager. Have a great week.